I feel like every video I've seen recently is a tour of the most expensive apartment ever built in the world in New York City. Woo, ah. And I get it. It's sexy, it's fun, it's great content. But at the end of the day, 99% of us aren't looking at that inventory realistically, and it has no value in helping you figure out how much home you can afford based on your yearly income. Likely. If you're making enough money to buy that unit and you need an agent, please give me a call. But the reality is, for most of us, we're looking at a much more reasonable price point. But we're going to talk about how much home you can afford if you're making $75,000 a year. Why $75,000? Well, the reality is when we look across the United States, when we look at Chicago, median household income is around $65,000 to $71,000. So if we're assuming that you're in that medium household, you have about $75,000 in yearly income to start distributing out towards your expenses, whether that be housing, debt, anything that comes up in your life. So today we're going to look at what can you actually afford, and maybe more importantly, what should you focus on keeping your maximum budget set at to ensure you're not house poor? When I use that term, I really mean that the cost of keeping up with your mortgage and the cost of your home is putting you in debt or putting you behind each month. That's not the goal of homeownership. It's meant to lock you at an affordable cost. And if you get lucky, you can refi down the line to get an even more affordable cost. But the goal of this is to prevent you from going through things like rental increase cycles, when you see things like 10 to 20% increases on the rental market each year. If you have a 30-year fixed mortgage, your cost of living is fixed, other than obvious fluctuations in things like property taxes or HOAs, depending on your building setup. But the goal of all of this is to make sure you're finding affordable housing that meets your budget. And how do we figure that out? There are some golden rules, tried and true methods that you tend to hear pretty often. One that I hear all the time from clients is kind of that 30% rule. Generally speaking, you want to see keeping the cost of your housing under 30% of your monthly income. So if we do the quick math, 30% of your monthly income towards your housing expenses. If you're making $75,000 a year, you're bringing home about $6,250 a month. You want to keep that to 30%. You're going to look at $1,875 per month as sort of your maximum ceiling for your mortgage, taxes, insurance, and HOAs if you pay them. Now that number becomes important. That's your guiding force. If you're looking to avoid putting yourself in a situation where you're going to be house poor, you want to make sure you're keeping your payment at that $1,875. The reason this is important is because this scales out. You can do the same equation if your income is $100,000 or $200,000 or $300,000 or $1 million or whatever it is, right? You can use the same equation. 30% of your monthly income should be your ceiling for your housing expenses. Are there going to be exceptions? I'm sure. Yes, absolutely. I mean, in some markets, sincerely, you cannot afford to buy a home like this. I'm thinking of places like San Francisco or New York, where income doesn't quite match the cost of housing. This is what many consider to be a practical approach to avoiding overspending on your cost of living, and one that I feel comfortable advising clients to at least consider when they're trying to budget out their expectations. The other side of this is obviously you need to talk with a lender. If you don't understand how much money is available to you from the bank, you really don't understand your buying power unless you have a lot of money saved in cash. If you're buying in cash, you have some flexibility. You don't need to have that lender true up. You can make some decisions on what you can afford after that lump sum comes out of your account. But assuming you're not making a cash purchase and you are going to be leveraged banking financing in some way, you want to understand how much money will the bank give you. If you've saved 10, 20, 25,000, whatever that amount is, you're going to need the bank's money to supplement that in order to afford a home. So you'll want to have a conversation about interest rates. You want to have a conversation about PMI if you're going to put anything less than 20 to 25% down. And these are all conversations that a lender can navigate with you when you're going through the pre-approval. If you have questions about buying a home, if you're thinking about engaging in that process, I've made content about it before. Check that video out and let me know if you need lender contacts. I'm always happy to refer someone who can take you through the process from A to Z. It doesn't involve a hard credit check. It doesn't involve submitting all your tax documents. It's a really stress-free conversation in order for you to figure out what your buying power in the marketplace is. Okay, now let's use these numbers to look at a real example. I'm going to pull a condo that recently sold in Chicago that, by the numbers we just discussed, would be affordable to somebody with a median income of $75,000. So, like I said, I just literally picked an address at random that met the affordability here. Let's look at 4902 North Drake, number 3. This is a top floor, 2 bed, 1 bath unit, about 900 square feet. You can see from the photos here, good hardwood floors. Kitchen looks like it's updated. It's got some real Chicago charm, in my opinion. It's nice. $175,000 was the sale price on this property. The taxes are 2707 a year. That's based on the 2020 number. It's probably adjusted slightly up from there. And the HOAs are 259 a month. Jumping over to our mortgage calculator. Again, I like Bankrate for this. I think they do a good job. I'm going to plug in the numbers that we discussed from that property. So 175,000. We're going to put 5% down, which is the equivalent of $8,750 over a 30-year fixed mortgage using an interest rate of 6.7%. Interest rates fluctuate. Talk to your lender. I'm just using a threshold. This is based on the actual property taxes that you're going to pay per month and the actual HOA fees you're going to pay per month, totaling a mortgage breakdown of 1656. Now, obviously, this meets the criteria we discussed. We wanted to keep you under roughly $800 for your monthly breakdown. This property would work for that. So this is the exact process I would be using when I'm looking for a home and figuring out what can I afford, right? Figure out your DTI, your debt to income ratio, come up with that ceiling number, and then compare that to properties in the marketplace. This property sold within the last 6 months. So there are properties out there active right now that would meet these criteria depending on your needs, right? Obviously, for some, depending on your bedroom count, this could be a stretch to hit this number with that budget. And I completely understand that. But this is a reality of where I would try to keep your budgeting month to month when you're trying to associate how much cost you can afford to spend on your housing. Hopefully, this was helpful. If it was, please leave a comment. If you have questions, leave a comment below. I'm happy to discuss. And if you ever want to sit down and look at how much home you can actually afford, please schedule time on my calendar. I'm so happy to help walk you through this process and help you find a home that's the right fit for you. Take care.